In this video, we're going to discuss the importance of risk management when you're trading the SPX for zero DTE trades or day trades. We're going to discuss the process of adjusting when something goes wrong. And we're going to provide a few different options on how you can adjust the trade to potentially win at a later time frame.
Please subscribe to our channel. Have fun trading!
We're not going to go over a stop loss based on the credit that you receive. So for example, the most popular way of handling risk management with the SPX zero DT trading is to get out based on a 3 times the credit you received, or 3 times stop loss of the credit you received when you placed the trade. So if you received $100, you get out if you're down $300. Okay? And then that's how you get out of it. And we talk about that in the statistical day trading course in the Dorian Way school, which Dr. Meadows has created. That course is a phenomenal course, and Dr. Meadows is one of the best zero DT traders in the world. And if you follow that course, you're going to learn a significant amount, and you'll be able to make some monies if you dedicate yourself to the process. And you dedicate yourself to the process, and you're not lacking discipline. Encourage you to go and look at that. But today in this video, we're not going to discuss, once again, the stop loss type of risk management. We're going to discuss how you can adjust the trade when things go wrong. It's a little bit more advanced, but you still have to have a significant amount of discipline, because if you don't, you can suffer huge losses and ruin your account and just discourage yourself from trading, period. So let me give some disclaimers. This zero DT trade or any kind of short-term trade is not for beginners. You don't just want to jump into zero DT trading because zero DT trading has the most risk. Yes, you can make the most. Right? You can make the most percentage-wise on your portfolio in a short period of time if you can consistently win with zero DT trading. This is why it's so attractive to so many retail investors out there. It's becoming so popular in the kind of YouTube space. But it does have the most gamma risk, and gamma is a derivative of delta, which delta measures your directional risk. Gamma measures how fast that directional risk is changing based on a percentage. So that means your risk can change significantly, the most on zero DT trades. So you have to be super vigilant about the process. And so if you're new to it, you want to understand every step you can possibly understand before you jump into it. And when you do it with a very, very small amount of your account. You make sure you can only lose no more than 2 to 5% on your account. Ideally, something 2 or less. And that allows you to be able to make money over time, because you're going to have some down days. Dr. Meadows, who I said is one of the best, if not the best, zero DT trader in the world, he has some down days. He has some down weeks. He has some down months. But overall, he's been significantly profitable from this type of trade. And for example, in 2022, he was up 10 out of the 12 months of the year with a really, really nice return on his capital. So it can be done in super volatile periods, and it can be done in low volatile periods. You just have to understand the process and have the discipline to follow the rules regarding the risk management. So if you're going to get out at 3 times the credit you received, you have to follow that. You have to follow that completely. Or if you're going to adjust the way we're going to teach on this video, then you're going to have to follow that religiously, dogmatically. All right, so let's jump into this. And that's going to give you a setup first, and then talk about how you can adjust and how we teach at the Dorian Way. This is going to be brief, but it's going to give you an understanding how you can do it. And if you want to learn more, you can decide to join the Dorian Way. You can decide to purchase the statistical day trading course. You can decide to participate in some of our webinars, or you can just, send us some questions and kind of fill us out. All right, so let's continue. We're going to set up this trade, and because this is the weekend, we do not have a zero DT trade weekend we can show at this point. But the same concept is with the 1 DT. We're going to act like this is a zero DT. So normally what we're trying to do is put on an iron condor and collect at least $2 or $1 on both sides of the iron condor. $1 on the put spread that you sell, $1 on the call spread that you sell, so total $2. And we try to have the width of the spread no wider than a 50-point wide spread. Sometimes it's got to be more than that. Most of the time we're trying to do something less than that. But in this lower volatility market, we have to go closer to at the money to be able to get the percentage we want or the dollar amount we want if we are using a spread less than 50, and sometimes even if we're using something more than 50 or 50. So let me give you an example. We're going to sell this 43.35, and then we're going to buy 50 points higher, and then we're going to sell the 42.65, which is 11 delta on the put side, and we're going to buy the 42.15 here. So this is 50 points wide on both sides. Okay? 50 points wide on both sides. So your max loss is $5,000 before the credit you receive. If you receive 225, then your max loss is going to be 47.75, as the TastyTrade platform is indicating here. However, you do not base your risk on this max loss, because you're going to be adjusting this, and you're going to be adjusting this before that max loss. You should never have this max loss. If you're doing the 3 times the credit that we talk about in the statistical day trading course, or if you're going to do the process we're going to talk about in this video of adjusting, you should never have this max loss, not even anything close to this max loss. You have to have the discipline to adjust. So you are basing your risk on the short leg. So on this side, on the put side, it's the 42.65, and on the call side, it's the 43.35. So when that delta becomes too high, then you're going to make an adjustment. You're going to make an adjustment. So this is how we normally set up the trade, to try to get at least $1 on each side, or $2 total, so that we can manage this trade and make a decent amount using just one contract. But in this lower volatility market at this point, you have to determine, do you want to go to a 10 delta? Do you want to go to a 11 delta? Do you want to have that type of delta range? Or do you want to take a little less to have a higher probability or be at lower deltas? So in this example here, let's just say we decide that we're going to go to, on this call side, to the 7 delta, and we're going to do a 20 point wide. And then on this put side, let's say we're also going to go to a 7 delta and do a 20 point wide. So in this example, you're only collecting $1, okay? But you might be okay with that. That's basically 50 cents on both sides. And in certain markets, you're going to be okay with taking a little less to be able to potentially reduce your risk. So if this is how you would set it up, and then let's just say now that it becomes a problem, okay? It becomes a problem. And let's say in this example, it's the call side that becomes a problem. And it becomes, you go from like a 7 or 5 or 7 or 8 delta to, let's say, a 32 delta. And you are concerned about the trade at this point. So it looks like this. What you can do is what we call is a roll away at the Dorian Way. And a roll away means that you're moving the spread away from at the money. Right? So this is the at the money line going across the middle here, this horizontal line on TastyTrade. That's where you're moving away from at the money. It's called a roll away. Some of you might heard of what is called a roll up. A roll up is when you're going towards at the money. That's how the Dorian Way considers it. Right? Regardless if you're on the call side of the put side, the Dorian Way uses the at the money line as the equilibrium, the baseline. So we're either rolling away from it or rolling towards it, okay? Rolling up towards it. Okay? All right, so in this example, if you want to roll away, you have a 20 point wide spread, and you're at a 32 delta, and you want to change that delta situation. So what you can do is do what we call as a roll away, and you can move the trade to something like this. And this is rolling the trade away 10 points. So you're getting rid of this leg and you're getting rid of this leg, and then this is becoming the new leg, and this is becoming the new leg. So if you move this trade away from at the money, it's going to cost you, in this example, $180. This seems like a lot. It might be that much. It might be a little more. It all depends on what's going on. You can decide to move this 5 points. You can decide to move it 10 points. In this example, I'm moving it 10 points. I'm going from a 32 delta to a 19 delta. So we're reducing the risk significantly, okay, delta-wise. But you have to be able to pay for that, because you only received, let's just say you only received $1, as we were just showing. You only received $1. So now you're down 80 cents before fees and commissions. So you want to collect something more than the 180, or something very close to it, so that you can have a credit still overall. So in this example, what you're going to do is move up the put side, and most likely that put side, if that call side has went from a 5 or 7 to a 30 something delta there, the put side is probably at a 2 or a 1 delta. So let's just act like it's at a 2 delta here. And this was the trade, right? It was a 20 point wide trade, and so this is going away. This is going away, and then you're going to move it up. You're going to move it up, and you can do this all simultaneously as one trade. So if you move this up, and let's say we're going to move it up to the 13 delta here, and we get 110. Well, now we're only getting 110. So this is not enough to be able to get the 180. So we're down $70, right? We're down $70. So overall, you still have a credit, right? You still have a credit of about, what is it, 210 minus, you still got a credit of about 30 cents, but you do not have enough for the whole trade. So what you can do at this point, you can decide, do you want to just go with that and hold this as long as you can so you can actually break even or get a little credit, or you can decide that you're going to add another contract to the put side for example purposes. If you did that, so now you're collecting 220, so you needed 180, so now you're going to actually have a $40 additional credit, right? So on top of the 100 that you originally received, now you're going to have $140. So how that works is that you originally received, let's do this math here, you originally received $100. Then you had to pay 180, let's just say. Okay? And so now you're collecting 220. Okay? So if you do the math behind this really quickly, you will see that you have the 100 minus the 180 plus the 220 will equal 140, as we indicated. You'll have 140. So that's the total amount that you receive. So as long as you can buy the trade back for less than, close it out for less than 140, then you have won on the trade, not including fees and commissions. Obviously, you have to factor in the fees and commissions. But to make this this example as clear as possible, you would have to buy it back for less than 140 to be able to win on the trade. This is what we call a roll away. A roll away includes a roll up so that you can pay for it. And sometimes you're going to have to add another contract to be able to get the premium you want without moving the non-tested side up. That's the side that you're rolling up towards at the money to be able to pay for the roll away that you did. You're going to have to add another contract sometime if you don't take that roll up to a higher delta. So if we would have went to maybe a 17 delta, maybe we could have been able to do it. So for example purposes, let's go to the 17 delta here, and let's move this back to one contract. So in this example, we would have got 160. So that would have been $20 less than what we needed before fees and commissions. But if we went to the 21 delta, then we would have got what we needed. But now you're putting too much pressure on the opposite sides. If the market goes down, it's going to cause a problem if it reverses and goes down. So you want to give yourself a little wiggle room to that downside. You can always add something to another position to the call side, especially if you feel like the market has been going up several days and it's still going up that day, that maybe adding another call to when you rolled it away to pay for it, that could be something that you do. So for example, if we go and we start to look at a roll out process, let's go with the same type of example, and let's say that you were at the 32 delta and you decided at this point that you did not want to do a roll away, or you've already did a roll away and it's still a problem and you want to roll out. But let's just say in this example, you did not decide to do a roll away, and so you're going to roll it out. So your put side, which is the non-tested side, is basically at zero. Okay? So this right here is going to cost you 40 or $400 to buy this back. So now you want to roll this out, and you can roll it out for the next day, you can roll it out to 14 days, and if the situation is really going really bad, you can roll it out 30 plus days. And sometimes you have to do that, but what you're trying to do is not lose on the trade or have a significantly insignificant loss. And you do not want to have big losses, because if you can keep the losses to a manageable level, the winnings will take care of themselves. You will be profitable with this trade if you can manage the losses. And if you can't, then this is going to, once again, you're going to blow up your account. All right, so if you had to buy this back, let's say it's for $400. If you're going to roll out, then what you're going to do is you're going to roll out into an iron condor. Okay? You can take off that non-tested side in the front month or that 0 DT time, or you can leave it there. It all depends on how much buying power you have. But you're going to roll out into an iron condor, and you're going to try to reposition the trade. So in this example, let's say we went to a 15 delta. We were at a 32 delta. We go to a 15 delta here. That's going to give us 205. We need $400, a little over $400. So let's say we went to a 10 delta here on the put side, and that's giving us $300. So this is not giving us enough, and we're not receiving enough here. So what we can decide to do at that point is we can move the call side up, the the tested side, we can move that up a little bit, and then that, if we move that from a 22 delta, then that works, right? We move it to a 22 delta. Keep in mind that you originally started, let's say, at a 5 or a 7 delta. An example we were giving, you had to go up to a 32 delta, so that means the market really shot up. And then if you roll out to the next day in this example, and you move from a 32 delta to a 22, so that's reducing the risk by 10 deltas. And then maybe the market slows down and you're okay the next day. If you're okay the next day, and this is how you got the premium that you did, you just extended duration, give yourself a little bit more flexibility. In the front month, you had a 32 delta, and in the back month you had a 22 delta. So this is 43.35 is where you're at on the back month, 43.35, and on the front month, as you can see, you gave yourself a little bit more wiggle room. Let's just go back to that really quickly, and you can see at this 32 delta, you were at the 43.15, so you gave yourself a 20-point difference. Okay? 20-point difference to give yourself a little bit more wiggle room. That can be huge. As you can see, the expected move here on the TastyTrade platform is just under 20 at 19.26. So that you just gave yourself a whole day's expected move, perhaps, right? So that's a big move. That's going to give you some cushion. This is how you can adjust these type of trades when you're not using the automatic stop loss of 3 times your credit, once again, that we teach in the statistical day trading course. This is an alternative to that. This can be just as powerful, but you have to have the discipline as we indicated, right? So you have to learn what is a roll away, and obviously the roll up, because a roll away includes a roll up. And then you have to understand the roll out. This is more of a Dorian Way repositioning type of roll out. When you roll out into an iron condor, you're just trying to collect more than it costs to buy back the front month to roll it to a later date. So we teach this at the Dorian Way. If you're interested in learning, please consider joining our trading club. You can learn these things. We appreciate you watching this video. Please like and subscribe if you found some value in it, and hopefully we'll see you in the next video. Bye for now.